Shared equity is a real option for first home buyers. But what is it? As price rises continue, interest rates remain high, and the years it takes to save a deposit keeps increasing, you could be forgiven for getting despondent. Today, we're exploring how shared equity would breathe new life into some first home buyer dreams.
Welcome to Your First Home Buyer Guide, the podcast for first home buyers who want to move it along and become homeowners. But most importantly, it is for you to become an educated home buyer.
I'm Megan and that was Veronica. We're both buyer's agents and probably old enough to be your mum. But it's a good thing because between us we've got over 45 years experience to share with you and bucket loads of stories about avoidable mistakes. Together, we're going to make sure you get unbiased and real information you can rely on. Allow us to guide you on your home buying journey. We want you to become an educated home buyer so that you can stop looking for your first home and actually become a proud homeowner.
We've got loads of great tips for you in this episode, and if you'd like more useful tools, head over to the website homebuyeracademy.com.au, and there you'll get access to our free mini course, How to Price a Property Like a Professional. You will also find the holy grail of home buying education, Your First Home Buyer Guide, the online course for people who want to become educated home buyers. We created this for you to help you get on the right path to home ownership for your first home and beyond.
But before we get into the interesting stuff in this week's episode, we've got the boring bit, the disclaimer. You of course know that nothing in this podcast is to be taken as personal advice. We always recommend getting the advice of an expert in their field who takes the time to understand your personal situation. We've done our very best to ensure that the content is correct at the time of recording. Things change rapidly, so always check with the relevant government authority and your trusted advisors to get the most up-to-date information.
Today we're talking about one new option for getting onto the property ladder for people who don't qualify for first home buyer schemes nor have access to the bank of mum or dad. Mum and dad, mum or dad. Today we have a guest who has been very busy coming up with a solution for people who have felt their dreams of home ownership have been slipping away. We have Evan Thornley, he's the CEO of Longview, and he's a technology and social entrepreneur who for the last 7 years has been consumed with seeking solutions to Australia's housing problems. And one such solution is a shared equity scheme for homeowners. And that's just what we've invited him to come along and talk to us about today. Welcome, Evan.
Great to see you both.
Welcome. I love this. And one of the main reasons I love what you're doing here is you're not excluding anybody, right? But we'll talk about that in a moment.
Yeah.
Can you explain to us what your scheme is? What's it all about?
Yeah, well, as everybody knows, to buy a home, you need a combination of your own savings, which you usually call equity, and then the mortgage, the debt from the bank. And you can only borrow a certain amount of money from the bank. They'll only lend you a certain amount of money, and you don't want to take any more of their money than you need because it costs a lot to pay it back. But the problem for so many home buyers, particularly early stage home buyers, is that they don't have enough equity in the first place to get the bank. The bank will only give you up to about 80% of the purchase price. You can get a little bit more, but then it starts costing you extra with lender's mortgage insurance and so on. So a lot of people, as we know, get the bank of mum and dad to help out with the rest of their deposit, with the rest of their equity. And that's great for people who have it. And I'll be honest, I've done that for my children. But for many people, there isn't a bank of mum and dad available. And so that savings process to get enough equity to get your deposit is really hard. So shared equity, and this is an idea that's been around for about 20 years in various forms. It's actually quite a mature idea, both in Australia and overseas in various different forms. It's not, we're not splitting the atom in new ways. And now there's all these stuff.
And that might surprise people because it feels a bit like a buzzword at the moment. It sort of feels like, this is new, but it's been around a long time.
Right?
Yeah.
And probably because the government has started offering shared equity. So the idea with almost all shared equity schemes is, hey, if somebody else can put in some of the equity to help the home buyer get the mortgage and buy the home, then that's a great way to get people into the home. And the difference with equity versus debt is there's no monthly repayments. It's equity. It's meant to sit there with the homeowner, and usually then it gets repaid when you sell the home. So now, obviously, if somebody's giving you money for that, whether it's the government or a private company or fund, there needs to be some investment return. But if you buy a good home that grows in value, then the value of the equity grows. And so the shared equity provider gets a share of that upside. And so effectively the home buyer gets to get a better home sooner, and the shared equity provider gets to share in the increase in the value of the home. And that's why it works without any monthly repayments, without any of the things that, banks and debt is completely different to equity, right? The bank doesn't care whether your home goes up in value or not. They could not care, right? All they care is that you pay their money back every month. And that's fine. That's what bank mortgages are here to do. But
very few people can buy a home without a mortgage, can they, Evan? I mean, at the heart of it, very few people can buy a house without a mortgage. So it's going to probably sit there for most people.
We have some of the highest prices in the world. So, almost everyone, if they don't have family wealth, is buying a home, and they're going to have a mortgage, and that's necessary. So we're not trying to add to the mortgage burden. There's enough of that already. We're trying to be the patient partner who can give you equity that doesn't need to be repaid every month, but which can get its reward if the value of the home goes up. And what I love about that is it completely aligns our interests with our clients' interests.
Yes.
Right? Our job is to help our clients buy the best possible home. And as you two well know, because we're colleagues and we have a range of professional buyers advisors, both in our organisation and that we work with in the buying advisory industry. Our job is to help someone find a home that is the right fit for them and their family, and that is also going to create wealth for them over time.
Because you've got a vested interest, and I think that's something that's important.
So many parts of the real estate and property and banking industry, the companies make their money from their clients, not with their clients.
Yeah.
What I really love about what we've done, and I've been talking about this for a long time. It's taken us 3.5 years to build this. There's a lot of work behind the scenes to make this really work. But, in simple terms, the investors who provide the money are only going to make $1 if the home buyer makes at least $2, right? And so I really think that's a great alignment. And our job as the folks in the middle of that is to help everybody by helping them buy the right home that's going to be a great fit for their family and is going to go up in value.
Now, I just want to step in at this point because I'm going to be devil's advocate, right?
Please.
Even though I think this is a great initiative, and I'll put it out there that I think that anybody is putting their own hard-earned, if you like, into try to come up with solutions. It's a business. Of course, Evan is running a business, but at the same time, he does have a social conscience. And so there's a bigger picture here, and that's why we're in support of this discussion. But I'm going to be the devil's advocate because, I just love to be the contrarian. And I want to make sure that if anyone's considering this, that they're also aware of what, the pros and cons that go with this. And also the type of buyer that might be best suited to investigating such an arrangement. But in order to do so, I think that what we need to do is very quickly understand where the money's coming from. Now, when people invest, and forget property for a minute, any type of investor, anybody's investing some of their hard-earned money or equity or whatever they're doing, whatever money they're investing, they expect a return. Some people invest money for dividends, and so they're investing for an income. Some people are investing for a long-term capital growth play, which is what we incidentally recommend with property anyway. And that is where you invest sometimes in a new business or in a number of different ways that you can invest for the future. And so you're pitching, or you've got your faith in an investment thesis, if you like, that's going to return a good capital growth after a period of time. And then there's also investments that's just like gold, and they're just for bonds that are just for safety, safe parking of money. So this is a type of investor that would actually sign up for this sort of fund and contribute money to this sort of fund that then would be available for buyers to use to help buy their home, is a type of investor who's looking for a long-term capital growth play. They're not looking to earn money every month. They're not looking for a contribution from the home buyer to pay rent towards them or anything like that. This is a bet on the ability of these people who are using the money vis-a-vis, through guidance, and we'll talk about how the hell do these individuals buy good quality assets so that therefore the investor can feel confident that they're going to get a return on their investment. But that's the sort of premise, and that's why the values are aligned, that it's in the investor's best interests that you, if you use their money, buys a good quality asset. It's in your interests to buy a good quality asset regardless of using their money or not. And in the situations where by getting access to these sorts of funds allows you to get a better asset than you would otherwise be able to get, or to be in a property for longer, then there's a good case for considering this as an option. So, but I'm going to definitely be devil's advocate and throw up some questions about the dark side of this as we move on.
I think your illustration of how we've tried to align everybody around one factor, a great home that gets good capital growth, everybody wins. That was great, but I'm not sure that was devil's advocacy, so I'm suspecting that's coming now.
Evan.
I'm putting people on notice. There's some
There'll be a
questions
sting in
coming
the
for
tail.
you.
I can feel it coming.
Let's get to some of those questions because I'm really interested. I mentioned earlier there are government schemes that use a similar terminology of shared equity. How's this different to those sorts of schemes?
Yeah, look, in a couple of ways, but I think the first way I'd say it's that the two most important differences are the government schemes. And I think it's great what the government's doing. Don't get me. It's wonderful. They're going to help a lot of people into a home who wouldn't get in one otherwise. But inevitably with governments, they have a certain amount of money available. They want to make sure it's given to the people who most need it. And so they have a whole lot of eligibility criteria as there are for so many different government things. But what that effectively means is for many kind of middle of the road home buyers, they're not eligible for the government money. So if you earn more than, there's different schemes, state and federal, but if you earn more than 120,000 or you want to spend more than 950,000 on the home or whatever, and, it's hard to buy a family home in Sydney, Melbourne or Brisbane for $950 these days, you're simply not eligible, right? So and fair enough, right? The government should be targeting the money to the people that most need it. I don't have a problem with that, but that leaves a huge number of people who don't have a bank of mum and dad, but who are not eligible for the government help. The second thing, which again is a bit, this is just, I guess, inevitable with government. I'll put it the other way around. At Longview, our most cherished belief about what we're trying to do with our buying boost offer is to make one thing super clear. It's your home. Okay. No ifs, no buts. We're not a joint owner of the home. We're not on title. We can't tell you to sell it. You have to ask our permission to do stuff. It's your home. That's the whole point of owning a home, is for it to be your home. The government scheme's sort of like that, but you need to report back every year. And if your income's gone up too much, they might have to get you to refinance out. And, and then if you want to do something to it, you have to get their permission. And I get why the government does that. But we just think that it is absolutely sacrosanct that if we're helping people buy a home, it's their home. So I think those are two differences. The third difference, which is the difference between what we're doing with Longview Buying Boost and both all the government and other private providers, is that our focus is all about helping you buy the right home. So that's why we have professional buying advisors involved. So we're not just providing you money, we're providing you with expertise. Somebody who's actually on your side, right? The real estate agent's not on your side. If you're lucky, the mortgage broker's on your side. Sometimes they are, sometimes they're on the bank's side. We're on your side. Our job is to help you buy the best home possible. And if we do that successfully, then the investors are happy, the home buyer is happy, and that's how the system works.
So I've got one devil's advocate for you, which is probably not what I was thinking I was going to be bringing up.
Yeah.
But that is like, if I'm an investor, so now I'm thinking about like the investor, not the first home buyer. If I'm an investor, I'm thinking I actually do want to say if somebody's going to go and paint the whole place pink and put Doric columns all over it, because that might actually take away some of that capital growth we're talking about. So perhaps possibly you might want to, add in the an advisory line, at some point, just so people can avoid making big mistakes.
I'm super clear. Obviously, I talk to both our clients who we're helping buy homes and to investors who provide the money. I'm super clear with investors. It's their home. And you should feel good about that, because self-evidently, when it's your home, you look after it.
Yeah.
Right. Okay. So we have in Longview, because we're a big property business, we manage 4,000 rental properties. And I'm proud to say we do it better than almost anyone else in the country. We've been awarded for that, both for our owners and for our renters, by the way. And so we know a lot about the world of renting properties and the challenges of it for both owners and renters. And one thing that everybody knows is that people who own their homes, on average, look after them significantly better than those homes tend to be looked after in a rental environment. So from an investor's point of view, you're getting a much better outcome on that without being draconian about it. You don't need to. Okay, people will look after it themselves. The second thing, to be blunt from an investor point of view, when we're buying quality family homes, most of the value in those homes is actually in the land underneath them. Most people don't understand that. And so this is why we say it's your home. Short of burning it down, you should do whatever you want with your home. A, you'll almost certainly do the right thing because it's your home. But B, the money that the investors are going to make is going to principally come because the value of the land underneath the home is going to grow. So really trying to police people in their own home is not necessary to deliver good outcomes for investors and would completely spoil the whole point of this, which is to help people buy a home that is their home.
I've got another devil's advocate question, but I want to save it for later, and it's about upgrading and renovating these properties. But we'll get to that. So, who qualifies? Who qualifies for this scheme?
Again, we're not in the business of making people eligible or ineligible. We're not here to evaluate you. We're here to help you. Now, obviously, we're only putting in some of the equity. So, if you don't have a decent amount of savings of your own, then we won't be able to help you because we're only putting in a minority share of the equity. Mm-hmm. So it's not that you're ineligible, but I mean, we can't help you if you haven't, got a decent amount of savings. So
what are we talking?
There's also
grand?
costs of purchasing and so forth as well.
Stamps just for starters, right?
So,
so again, we're not here to evaluate you. We're here to help anyone who wants to buy a home that is good quality home. So our job is to focus on the asset, but obviously you've got to be in the ballpark of having a chance to buy the home. And with our extra equity, it actually means that you can. So, if you've only saved up 2 or 3% of the purchase price of a home, we can't help you get to 20 from there, right? The government can. I think that the government will talk to you if you've got 2. And again, great that they do. So
if you meet the criteria,
people we're helping have at least $100,000 of savings. And that's even for a modest home, as you know, if you're trying to buy $1 million home, you need about $200,000 for your deposit plus the stamp duty. So people have got to have proper savings, but again, we're not here to evaluate them. We're not here to ask about your job or your credit history. The banks will do that.
That's the bank's
job. You get a mortgage from the bank. They care all about that because their job is to make sure you pay them money every month. Our job is to make sure you buy the right home.
And the other thing, though, that is a qualification is where you want to buy, because you guys are really on Eastern Seaboard and you're really around the 3 major cities there, right?
Yeah, look, we're just starting out after 3.5 years of building this. So we're helping clients now buy homes in Sydney, Melbourne, Brisbane, or I would call it Greater Sydney, Greater Melbourne and Greater Brisbane. So, Southeast Queensland, Sydney, Central Coast, Wollongong, Melbourne, Geelong, but the 3 major urban centres at this stage. We'll probably expand to Canberra at some point, and I'm sure in the fullness of time, my apologies to your audience in Perth and Adelaide and Hobart. I hope we'll get there in the fullness of time, but initially we're doing Sydney, Melbourne, Brisbane. Yep.
Now, our audience, of course, is largely first home buyers, and this, of course, is something that you can certainly look into, but you're not just here to help first home buyers, are you? There's
it's funny, we started building this with the first home buyers in mind, and I think it's a wonderful product for many first home buyers. But then people started coming to us and said, again, are we eligible? We're not first home buyers, and I'll give a good example and a sad one, but a lot of people have been through a divorce, are now rebuilding their lives, don't have the amount of finance and equity that they used to have. And it's really important at that stage in their lives, often with growing children. There's a big difference between what you can afford with a bit of extra help from us and not. So they were saying, are we eligible? Can we get your help to buy a home, or do we have to be first home buyer? And we were like, of course you're eligible. We're here to help you buy a good home and a better home sooner. That's our motto. So we're in no way restricted by who. Again, it's not about who you are. It's about whether we can help you get a better home sooner that will be a good investment for you and therefore for the investors that are providing the money.
So it could be first, second, fourth, seventh.
Single, couple.
We're definitely seeing, what I'd call, as you would know this group well, upgraders, right?
Yeah.
Let's say they're the folk in buying their second or third home. Maybe the kids are moving into high school. That's kind of the time when, that's probably the biggest and most expensive home you're likely to buy in your life. And you really want to stretch to get the one you want. And, we've given some of those clients extra money that gets them really the family home that they want now. their next home is probably going to be a downsize. So obviously they've given away a little bit of the future profit, of the future upgrowth in the value of the home, but they've got the money now to buy the home they really need to live in. And I think that philosophy, though, goes right back to first home buyers too. Part of the reason people try and get on a housing ladder and be able to step their way up is they have to be able to step their way up to what they can afford. Ultimately, they're probably trying to get to a quality family home, particularly if they've got kids, growing. And, part of what we're hoping to do is get them, to use our slogan, a better home sooner. Maybe we get you one step further up the ladder earlier, right? Which means you buy one less home, which means one less lot of stamp duty, one less lot of moving, one less lot of time to have to get to know new neighbours, move to new schools, all the things that are really disruptive. I think most of us are wanting to live, as long as we can in a home that really works for us and be part of a community. And so we hope that part of what we're doing is helping people buy less homes and better ones sooner.
Yeah. And less of those stepping stones, less need to move. So, okay, and with that, what I want to get is a greater understanding of the equity, if the share in the equity uplift, so the share in the upside. Because let me just put it sort of on paper. If you say I could buy $1 million, say I could buy a property for $1 million unassisted, right? Yeah. But a really good property for me would be a $1.2 million property. Yeah. And if that was the case, I was able to buy an extra bedroom and maybe bigger yard and I could definitely see the kids could stay there through high school. Cool. So in order to do so, I say, great, Evan, I'd like to sign up. I'd like to take advantage. I want $200,000, right? So the property, I go from being able to buy a $1 million to buying a $1.2 million, right? And then the day I buy it, presumably it's worth $1.2 million or I haven't overpaid. And then over time it goes up in value, right? And say in 10 years' time it's worth $2 million. Hopefully it's worth more than that, but say it's worth $2 million. So there's $800,000 growth in that time. What's the share for the investor versus the share for me as the buyer? So when you say a share of the upside, how does that $800,000 get divvied up? Yeah.
And so let's be clear, this is only ever a share of the upside.
Right.
Yep. And so the investor is taking a lot of risk. What if there's no upside? What if the property market crashes? What if the home goes down in value? Yep. Okay. We're equity investors. We ride up or down with the client, right?
Yeah, and also the client gets to live in it the whole time. They get the benefit of the
It's not like the bank. The bank does not care. You owe them the money no matter what, right?
Yep.
So it's a very different thing. So it's important. And it's not a share of the whole home.
No.
The value of the home when you bought it, that's all yours, right? We're only getting a share of the upside that we
plus you get your 200 back, right?
Well, we get our money back,
Yeah. 200, so you get your 200 and then so on the 800 gain.
So look, it's self-limited to a maximum of 1/3 of the upside.
Right.
So the real question is, and we go through each client and each asset separately, so we won't try and do the math on screen here, but the question is, what's the maximum amount of money we're willing to give you for 1/3 of the upside? And the reason we chose 1/3 was kind of what I said earlier. I always want to be in a situation where whatever, and let's hope the investors do make good money. Otherwise, we're not going to be able to get any money for future funding, right? But if they do, the only way they can make good money is if the client makes twice as much. So,
right, okay.
So in your example, if there was 800,000 of capital growth, and the investors have 1/3 of that capital growth, and they'll have 1/3 of the 800, and you'll have 2/3.
I wish I'd picked the 900 capital growth. It'd be so much easier.
Yeah, it would have been so much easier.
The numbers would have been a little bit more straightforward.
Yeah. And that just proves I didn't know the answer. It proves I didn't know the answer to the question before asking it.
But again, I think the important thing to understand is, like, that all looks great in retrospect, but the investor is taking all the risk on whether that actually happens or not.
Of course.
Again, it's not a bank. The investor has to hit and hope. Now, our job is to help buy houses with the clients that we think are as certain as possible to generate good capital growth for everyone's benefit.
And so the downside of that, just so people understand that, is that, if this isn't your sort of, when I say forever home, your largest home you're going to own, then, and you take advantage of this, or if you buy into the property market, your first property, and you're buying a property that you are going to outgrow in sort of 8 to 10 years, then you are going to then have to forego a third of the equity that you've gained in that
third of the upside.
Sorry,
not
a
the
third of the
equity.
Upside.
Yeah.
or the equity, the upside, the equity that you've gained, right, in that time. And so it is going to make upgrading harder. Now, of course, if you've gone and got a fantastic asset that has absolutely blitzed and outperformed everything else, then, you know, all things being equal, you might end up being the same as if you bought a piece of crap
And look,
all
we
by
run
yourself.
these scenarios all the time, Veronica, to you know, obviously there's going to be occasions where by the end of it, you come out with a little less money than you would have had you not, because you've got to live in a better home for 10 years, right?
Yeah,
So,
exactly. It's
but
how you measure.
There are also scenarios where you actually, even then, not only do you get to live in a better home, but you actually come out with more money, right? So for starters, you're getting capital growth on a bigger asset. So the total amount of capital growth is higher.
Yeah.
And secondly, our job is to help you perhaps buy a home that would have got better capital growth than you might have bought without our help. And so the rate of capital growth. So I'm not here to guarantee that you'll physically come out with more money than if you'd never taken it. But it's kind of hypothetical, right? Because you would never have even be able to buy that home without
That's exactly right.
first.
But what I'm trying to illustrate here, though, is that if somebody is buying something that is still not going to be it for them, you know what I mean? It's still not going to be big enough for them in the longer term or even the medium to longer term, then they have to understand the limitations this will impose upon them upgrading. And maybe then they need to do it again for the next property, do another, you know,
and
equity
And hopefully
player.
we've helped you buy a better, more expensive home that has stronger capital appreciation, and you'll end up in the same place or better than you were before. But either way, the thing I'll guarantee you is you'll live in a better home sooner for as long as you're there. And my hope is we've done such a good job that you actually come out with even more money than you would have without. But obviously, it won't always be that way. Yeah.
We talk quite a bit about, and we've done some interviews where we've talked about people sort of stepping back and rather than just taking, you know, some of the advice they get from social media forums of, you know, avoid LMI at all costs or don't get involved in, you know, anything like all of these kind of preconceived notions that people develop over time because of what other people think. And it's about actually stepping back and going, this is another option. I need to explore it for me. What are the pros? What are the cons?
And
it's not free money.
Say, do your right? Do your homework. These are big decisions. They're complicated, just like the mortgage is a big decision and complicated. Taking additional finance from a shared equity provider is a proper decision that's about serious money, and you should do your homework. You should get good advice, you know, with the mortgage broker or a financial advisor. And, you know, I guess, look, we're in the fortunate position with what we're trying to do with Buying Boost at the moment. There are so many people who need that help. We don't need to go out and try and give it to people for whom it's not a good solution, right?
Yeah.
Like, we just don't. So, you know, we come across clients that come to us and we've said, actually, I've got to tell you, you're actually eligible for the government scheme.
Yeah.
That's a better deal than ours. Now, it has these limitations, but I think you should look at that first. We'll try and help you get it. You know, I'm not here to try and sell money to people that don't need it, right? That's what banks do, right? We're here to try and help people buy really good quality homes and get the extra money that they need to do that. And if we do that, everybody wins. And we don't need to do anything else, thank God, because that's why it took so long to build this, was to make sure that it actually had everyone aligned.
And it goes back to our principles of buy the best property that you can within your financial means, without stretching yourself to the point of eating tuna and rice every other day. But it does go back to that point of your focus is on, and I think this is why we have such good and rigorous discussions, your focus is on the quality of the asset.
And you know, what I find very gratifying, and you as, you know, long-time professional buying advisors would deeply understand this. You know, for the first time, the buyer's got someone genuinely on their side, you know, and we try and give our best professional advice and work with buying advisors to give their best professional advice. And what I find gratifying is one of the reasons the clients actually believe it, because everyone tells you they're working in your interest, like the sales agents do and the banks do, and actually they're not, is we're putting proper money under your backside for the next 10 years, right? So we found there's not a lot of pushback from clients with the idea that they can actually believe that our advice is genuinely in their interest in terms of the right home to buy. You know, We're not selling them the home. We're not taking any kickbacks or anything else, right? The only thing that matters is to help the client buy the right home. If they buy the right home, they'll do really well. Most importantly, the investors will get a good return and they're happy. We will build a business. So the clients have confidence that we're on their side. Not because we're nice people, though I'd like to think that is also true, but frankly, because we're just, we're completely aligned in our interests about buying the right home.
So there's two things that come out of that for me. One is that if you don't use this to get the best possible asset you can get and effectively the biggest possible house you can get, for your needs, then it's wasted in a way. This is really where you maximise in. But the other thing that I think is important too, you did say earlier, and I want to clarify this, you said that, you're not going on title. You're not a co-owner, right? My understanding is the government effectively are co-owners. That's my understanding. So instead, I'm guessing you're putting a caveat on the title. Is that the way it works?
Yeah. So it depends on who your mortgage lender is. We'll either put a caveat or we'll have a second mortgage, but it's not a mortgage that you have to pay back every month.
Got it.
You can't default on us. So the purpose of
it's covering you, so you get paid at the end. The purpose
of our security, whether it's a caveat or a mortgage security, is to do one thing and one thing only: to make sure that when you sell the home, you pay back the contract as agreed.
Yes,
obviously, the investors need to have that protection. But you can't be in breach of it like a bank mortgage. We can't sell you up. So you don't owe us anything along the way. So there's nothing to be in breach of. So
there's no
security to make sure that you honour the deal. Because frankly, the home buyer gets the entire benefit of the deal until the last day when they sell the home.
Sold.
We need some legal protection to make sure the investors.
You can't go and knock on the door and go, "We want to check on how our investment's going." It's like,
they're not having inspections every year.
None of that.
Got a question about
it's
that.
Your home.
Can I ask? So just trying to think through different scenarios. You always plan for the worst and then work towards the best. But okay, let's talk about some different scenarios. So generally, your investment is paid back and the share of the upside on the sale of the property.
Yes.
What in the case a couple have bought a house, there's a divorce, the house isn't actually sold?
Well,
how would that kind of be looked at?
Then we have that interest in the home.
Stays on the property, on the title.
And so our interest stays in the property.
Okay, so then
when that property is eventually sold,
can they buy you out at any point during the process?
Yes,
okay,
they can. So and I think a number of our clients will do that, and we've seen that in shared equity schemes around the world.
Yeah.
It's fine. So if you're in a position, let's say, your income's often gone up, the value of the home's gone up, perhaps interest rates have gone down, or you've got a bonus or an inheritance, and you go, well, I'd prefer to buy the rest of my capital growth back. Thanks very much, but I don't want to sell the home. Then we just get the home valued at that point in time by a registered valuer, apply as if you'd sold the property at that price, and then you buy out the contract for what you would have paid back if you had sold the property.
Okay.
And what if you renovate? Because if I buy, my $1.2 million house, and then, 5 years down the track, I'm going to do an extension. It's going to cost me another $500,000. Right? Instead of paying you back, I decide to invest further in the property. And so does that change then the ratio?
Look, we thought a lot about this, Veronica, and sort of tried to keep it simple, but based on our experience. So at the end of the day, the assumption is that we've done a deal for a portion of the value of the property. We're not going to change that deal unless there's a good reason. But a good reason is a structural renovation. So in broad terms, what we say is cosmetic renovations, the benefit is principally to the person who lives in the home. And over a period of time, that benefit gradually disappears. And likely by the time you've sold it, it isn't changing the value of the home much, which you know. A structural renovation, broadly speaking, adds roughly the cost of the renovation to the home. So if you bought a $2 million home, you add 2 bedrooms and a bathroom for $500,000, you'll probably get the extra $500,000 back when you sell it. So with a structural renovation, if the client wants to do a structural renovation, we'll adjust the original value in the contract to include the cost of the renovation. But if they're doing cosmetic renovations, then we don't.
Yeah,
So
great.
again, we were happy to look at every case individually with clients, but that's our basic rule. I think most people think that that's fair.
Changing
Sometimes
the cost
people,
base.
as you know,
It's cost based.
sometimes
Yeah.
people think they should have been on the block, and they can spend 150 on a cosmetic reno, and they've added, $750,000 to the sale price.
Yeah.
We don't think that actually happens, or hardly ever. So sorry, but if you think that that's what's going on, and we're somehow getting a free ride, then for goodness sake, just buy us out and knock yourself out. But most people I think that our solution is fair. They can understand. In fact, a lot of people didn't realise the difference between a cosmetic and a structural in terms of sale value. And like many of these things, it's quite educational for clients to have the conversation.
It is a good point. The reality is, if you do your cosmetic upgrade just before you sell, it could actually have a huge impact on the sale price.
Well, that's right. And actually, and maybe we'll help co-fund that if that's a good investment for an immediate sale. But if you do it at the beginning, you're going to live in it for another 10 years.
Yeah, it'd be devalued by the time it needed to be done again.
Yeah.
Yeah, it's
So
interesting. Interesting stuff. And so what's it actually called, Evan?
So Longview Buying Boost is the product.
Right.
So better home sooner.
Okay. Now, I guess we'll put a link in the show notes.
Sooner.
We'll put a link in the show notes for people to look into it. Another question I had for you, though, Evan, is you talked about getting advice, right?
Yes.
Now, it's really difficult to get financial advice because there's less and less financial advisors out there, right?
Yeah.
And the cost of advice is going up. Mortgage brokers typically aren't necessarily equipped to advise in this space. Property advice, well, we all know you don't need, or do we all know, but if you don't know, you should know that property advice is not regulated. Anybody can give you property advice without any qualifications. They can effectively leave school in year 10 and give you property advice. So don't ever go to a property advisor that's not at least PIPA qualified, with the QPIA, but that's another topic. So your accountant perhaps might be able to run some numbers for you, but in terms of where do you get advice, how does someone really, or a legal advice perhaps? I mean, what sort of advisor would someone go to say, right, is this the right thing for me? Is this, because, we all say this, go and get advice, but...
Yeah. I wish there was an easier answer to that in all cases. We try and help people who don't have, sometimes we come with clients who don't have a mortgage broker. We'll suggest a few that we know who we think are reputable, or a financial planner. You try and help people find the right folk or accountants. But obviously the provision of financial advice is a highly regulated and licensed profession, as it should be. And so, we can't give that advice, and obviously we're focused on what's happening on the property side. So, we try and help folk find people that can give them good advice. And
it's a tough one.
Yeah.
Yeah. We'll accept that it's a tough one, and unfortunately, it's the downside of increasing the regulation in the financial advice space is that there's less advisors out there, and then we've got the opposite problem in property space. So be careful who you go to for advice. But I think possibly an accountant, just to crunch the numbers and potentially run through some scenarios for you, might be a good way to go about that. And obviously a lawyer to advise you on the obligations that you'd be signing up for. And so you're very, very clear on how that might look down the track. But I do think it is something that is definitely an option for certain types of home buyers, and certainly in the major capitals who are really precluded from getting help and assistance to buy a property.
Look, when we've talked to some clients' advisors, we've say, hey, why don't we send you our spreadsheet? Obviously, you're the advisor. You can decide whether you think our spreadsheet's accurate, or you can use it to test sensitivities or whatever. So we heard it. We're always happy to talk to a client's advisors and answer their questions, and let them, do what they should do, which is protect their client's interests and make sure that what we're offering is the right thing for their client.
Yep.
Now, it really does sit really well with our principles, Veronica, which is about educating people the entire process of how to buy a property right from the start, all of the different options that are available, all of the different professionals and experts in their own field that they need to gather together to get, to have their team ready to go. And then making sure that they're taking all the steps in the right order to buy the best quality asset that they can within their financial means. And as you pointed out, Evan, this is potentially another thing to look at that may get them into a better asset than they could have if they didn't have access to a scheme like this.
Yeah.
Yeah. And look, as you understand, because we've known each other through the years, as colleagues in the buying advisory industry. This is a product and a platform that we developed coming out of the world of helping people buy good properties. You know, we're not bankers, right? We're not people who are in the business selling people money. That's not the world we come from. We come from the world, our whole, purpose in life as an organization is to help people buy good property. And then if it's an investment property, we manage it for them. So, this came up as a solution to client needs that we saw, that we wanted to fit in with everything we believe and you believe about the best way to buy the best property.
Yeah.
Can I just pick up on that? Because I think I just want to make sure that people haven't misunderstood what you've said there about investment properties. You do manage investment properties.
We do.
But this is not a platform for investors, is it?
No, it's not. We're only doing this with owner-occupiers. Yeah.
Homes. This is for homes, for people to live in.
Better homes sooner. Yeah. We have other services we offer to people who are property investors, and that's fine, and we help them do that well and look after renters better, I think, than almost anyone else does. But no, this is all about helping people buy a home, better homes sooner. Yeah.
Now, Evan, in sort of wrapping this up, we do have one question we ask every guest, and that is, what is one thing that you know now that you wish you knew when you were a first home buyer?
Oh, man, I think it's what we're talking about. I mean, we all buy a home because it's the place where we're going to nurture our most important relationships. And it's a very emotional decision for that reason, and it should be. I don't think I truly understood, and we're vaguely aware that, property often goes up in value. I had no idea, and I think most people don't, that all properties don't go up by the same amount. That the difference between buying a good home and a not so good home is easily $500,000, often $1 million or more over the next 10 years.
Yeah.
It's just, you shouldn't be buying a home for the principal purpose of making money, but oh my goodness, the magnitude of the difference. We show people case studies all the time of two assets that were bought 10 years ago at the same price.
Yeah.
And here's what they sold for last week. And there's between $500,000 and $1 million difference, right?
Yeah.
I didn't know that. I didn't know that was a thing I should have in my mind. I'm not saying people should focus on the financial outcome to drive buying their home, but they need to be aware that it's possibly the single biggest number on the page for their family's financial future is the difference between buying a good home and not buying a good home. And I was lucky. I ended up buying quite a good home, but purely by accident. So, yeah.
Well, we're with you on that. And some time ago, I discovered the same thing, and that sort of laid the foundation for certainly my own personal approach to advising people on buying property. And I know Megan's, got a very similar process of awareness, I guess, and it's accidental because it wasn't taught, and literally until we started teaching it, to be honest, I'd never heard it being taught anywhere else.
Well, but why? And this is what we've discovered as we've been doing this. There is not a single company or industry in this country whose business is made more successful by being attached to high capital growth properties. Right? Property developers don't. They build it and flip it and trick it, right? Banks, it makes no difference to them. Real estate agents, it makes no difference. So all the industries and all of the businesses around our space, it makes no difference to any of them about whether or not you've bought a good quality asset. So we've tried to build a business which is all about whether you bought a good quality asset. And if and only if we help our clients do that, then we'll have a proper business as a result.
Share in the benefit.
Yeah.
Now, a quick note for our listeners, you might think that we cover everything that you need to know in these podcasts. Our word of warning, however, we do not. We just scratch the surface. And if you really want to be an educated first home buyer, you need to learn all of the steps and how to do everything in the right order.
Yeah, our first home buyer guide course only costs $990, and you get direct access to us to help guide you through your negotiations. Veronica, in Campfire today, which is where we do the group mentoring, we had someone bring 2 properties to us that were poles apart. Evan, you talked about the difference in a little bit of difference in capital growth. This would have been that $1 million difference in 5 years.
We took an A grade versus C grade.
Yeah. All day long.
Don't trust me,
That's why I always love joining you two. I think what you're doing is great. I really love what you're doing with Home Buyer Academy. And so it's just a wonderful service that you're providing. And keep doing what you're doing. We'll try and help.
Well, thank you. And trust us, you'll overpay a hell of a lot more than $1,000 if you don't know what you're doing. But that particular example that Megan was just talking about, over years, that would be hundreds of thousands of dollars difference. And that is what $990 saved them. Hundreds of thousands.
Mate, it's, as I say, it's the biggest number on the page.
Yep.
Right.
Thank you
really
again,
It feels
Evan.
like so far down the track, but we need to bring it a bit more front of mind.
Yeah.
Oh my God, yes, because it makes a huge difference to your life. So look, Evan, thanks so much for coming along and
Thank
explaining this to us. We're going to keep in touch and over time, and we look forward to hearing some case studies actually. So
Yeah, I'd love
We'll
to.
get you
We've
back
got
sometime.
some great case studies already. So yeah, look forward to it. And for the folks that are watching, if we can help you buy a better home sooner, then come
Reach
talk
out.
to us about Buying Boost. So thank you.
In this episode, we've only touched on a tiny part of the huge amount of things you need to know to become an educated first home buyer. There is so much more for you to do. You can learn all of the steps in the right order and avoid all of the mistakes that others have made in our 10-step online course for first home buyers.
if you'd like to learn more about the right process and avoid making rookie errors, become an educated home buyer. Head over to the website, check out your first home buyer guide, the course that we have created for you. And don't forget to subscribe to the podcast so you won't miss an episode. And if you've liked what you've heard today, please give us an iTunes review. It helps other people find us. And of course, I know it's a bit cringy, but we're going to ask for 5 stars. Thank you.
Thanks for joining us. We hope you've found this really useful. And if you have, please share the love with others who you know are in the same boat. We'll be back next week with more priceless stuff.